Hey guys, Chilson Day here. Today we're going to be talking about here's what happens when a stock runs out of shares. This is important because when a stock does run out of shares readily available to the consuming market, this is called the float. It can lead to a parabolic spike in pricing, either upwards or downwards. Essentially, to summarize everything, as a stock begins to run out of a float, which is the amount of shares that can float in and out of accounts, public accounts in the market, it becomes more and more volatile. Now, the reason why this can happen is because in 1981, the SEC created the stock borrowing program. Basically, this means that brokers can borrow shares out of your accounts or out of any account, so long as you agree to it, to then turn around and sell them essentially to market to allow for volume increasing. Now, the problem is when you put these shares on a loan, they eventually have to all be called back. And this is where you can have a huge problem because I'll scroll down here just to show you, but this is what happened with GameStop, for example. In August of 2020, GameStop was $4 a share, and then over a couple months, this stock borrowing program is going into effect, where I think the float was like 70, 76 million or something at the time. And what happened was the volume was 100 million, 200 million, so 120 million shares were a part of the stock borrowing program. They were out on a loan, which means that it had to eventually be called back. Uh, Now, when you loan out shares, people to pay interest on it. It's essentially, you can think of it as like a normal loan. Now, as the float started increasing steadily over time, but more as like the volume started increasing, the stock borrowing program was in effect. As we can see, the price started going up and up and up just because typical supply and demand curves. Eventually, this hits a parabolic point, which me and a couple other people in the industry saw as early 2021 January. At this point, it was like reading a book. You just something was going to happen. We didn't know how high it was going to go. We didn't know how long it would be, but all these shares had to be called back in one moment. FINRA regulations state that if you don't have, I think it's 25% capital in your account to cover the loan, they instantly close your account, which means everything's sold at market value, and they pretty much declare it as a tax write-off. They being the brokers or whoever holds the credit on the loan. So this is what happens when shares run out. Uh, you have an amazing opportunity, right, as a retail investor. Because if you could see this happening, you just have to keep tabs on it. But it becomes like reading a book, essentially. Uh, if a float is like 50 million and the volume is 100 million, typical supply and demand curves just simply indicates that whichever way the price goes, it's going to go parabolic as more people sell and more people buy. What you really need to follow here is volume. There's other ways to do it, such as following MMIDs or like level 2, but in reality, just worry about the float and volume to start off with. Uh, yeah, so I mean, how you position an investment to do this, you either have two options. You can either, buy or short shares. I wouldn't really go short on these types of positions because they move so fast. You could just be, margin called. Regulation T is, I think, what it's called nowadays. But another way to do it is to do OTM calls or puts. Uh, that's what I like to do personally. Now you need to realize that with an OTM call, it's a contract, which means every single day you hold that contract and it's not like in the money. You're actually losing money. The contract itself is declining in value, is essentially evaporating away. We call that theta decay in the industry. So you realize that when you take out an option, it's not an investment. It's more of a liability because over time the overall contract value will decrease. But still, if you're right, and remember, you can when you see the float loading up and the volume loading up and the stock borrowing program going into effect, you will begin to see all this stuff happening. And when you're right, which it takes a little bit of time to accurately predict these, uh, I mean, no one's perfect. I mean, you can get it right probably around 60, 70% of the time. Then it's just a numbers game. Um, when you take out these OTM calls, you just wait. I mean, I when I did it for GameStop in January, the first OTM set I did was like I think $90 when the stock was $35, and I only used $200, but I turned that into $2,000 just because of volatility increase. And what that means, if we go back up here to the chart, I took it out over here. You can see the little chart line I drew, because I saw this effect was happening. You just drop $200, pocket, not really pocket change, but it's just something you can throw around. And what ends up happening is, if you're right, the volatility here, pretty much volatility is just saying the stock within one standard deviation is just going to maybe go up to 60, maybe it'll go down to 4. Who knows, right? But the volatility was not accounting for a rise up to like 150, 200, $300. That massive volatility spike meant my out of money contract option, which is up here at like 70 bucks, let's say, is now so far in the money that it's worth an insane. It'd be like turning coal to gold, right? And that's what happens with these OTM calls, and that's one of the ways you can play this. Uh, there are other ways to go about this. This is my personal website, so you guys are free to come on here and learn more about it. But there are arbitrage trading strategies you can employ, where it doesn't matter if you're right or wrong in which way the direction moves. So long as volatility increases, you'll make money. Those are a little bit more advanced, but I'm here to teach you guys how to essentially make money. So yeah, anyways, that's what happens when stock runs out of shares. It's a pretty eventful moment. It doesn't always happen in the market, but if you get it right and you know how to predict these and know how to read all the parameters in the market properly, uh, little like supernova events like this, you can make a lot of money off of. So, anyways, yes, this is Chosen Day with Chrono Historia. Feel free to subscribe and link. We have a newsletter that we send out just to keep people updated on what's going on. And as always, you can reach out to me either on Reddit, Twitter, the website, Chrono Historia, to ask any questions. There's a link below in the description if you're interested in learning more about this. I highly recommend you check out the article and the other articles. And until next time, best of luck on your investing journey, and Chosen Day out.